So whether we are seeing less or more synchronized global growth. What you have there is the forecast that we have for growth and inflation for the main regions, for global and for the main regions. Those are average growth forecasts. But for the sake of this point, whether economies are more or less synchronized, since we have been taking a look at 4 years period, it's an average growth forecast for each year. And then you have inflation. And what you can see first is that at the global level, you have a bit, or you're going to have probably a very slight deceleration. You can call it rounded error between 23 and 24. So the economy at the global level, the global economy is going to grow around 3%. And then we're going to have a bit of an acceleration in 25. But when you go into the details, there are different stories. So you can see that the US economy has been way more resilient than expected. And the US economy is going to do well this year. It's going to decelerate somewhat in 2025, but not much below potential growth. Okay, so the economy is going, some people call it a bit of an overheating of the economy. Some people call it it's right in the sweet spot. It's not too cold or too hot. The economy is doing okay. It's doing well. And the economy did well and came out of the pandemic in a pretty resilient fashion. When you take a look at the euro area, it looks like there is a mistake in the numbers that someone forgot to put in a 1 or a 2 in front of the column, but it's a reality of euro area. And if you add the UK, it's not much different. Actually, it's a bit worse. So euro area has been hit much harder by the same type of shocks, and that has to do with the rigidities of the region, particularly in the labor market, and the fact that monetary policy, in particular fiscal policy, has been less expansionary than compared to the case of the US. Like the flexibility of the labor market and the way fiscal policy has been implemented during the pandemic explains the difference. And the second part of the story is the size of the energy shock for Europe was much bigger than for the US. Japan will, on average, will slow down. On average, growth will slow down this year and then come back into next year. The question about Japan is a little bit more on how resilient is the increase in nominal wages for the Bank of Japan to feel comfortable removing the YCC framework and the negative interest rate policy. And so see that the BOJ wants to see more evidence that this is a more robust dynamic before pulling the trigger, because it's a very irreversible decision. And many central banks are in that camp. When you think about the BOJ, when you think about the Fed, when you think about the ECB, those three central banks are in a position where they need to initiate a new cycle, either a hiking cycle for the case of Japan, an easing cycle for the case of the Fed and the ECB. And it's not the same to change 25 basis points in the middle of an easing cycle or in the middle of a hiking cycle, that the first 25 basis points when you start an easing cycle or a hiking cycle. Because the last thing a central bank wants to do is to start the cycle and 2 quarters later to abort the easing or the hiking cycle because they screw up and they didn't see something coming. It's not just that they see that inflation is coming down and then they start cutting. They take a look at the variance, not only about the expected inflation, but also the variance of inflation, and especially the worst case scenarios. And then we have China moving into the emerging market side, where in China we see a more secular slowdown. Sequentially, we can see some pickup that would have to do some pickup in the first half of this year, would extend maybe to the third quarter. That has to do with the size of the fiscal and monetary stimulus that authorities decide to implement. But obviously, confidence is low in China. And by the way, confidence is also low in Europe. If you compare the excess savings dynamics because of the pandemic and because of the fiscal stimulus in the case of the US and Europe, houses accumulated a lot of excess savings. In the US, houses have been depleting those excess savings, that have been consuming. In Europe, maybe they consume 20% of excess savings and 80% still to go, almost the opposite of the US. And in China, excess savings are probably even higher. Okay? People are not so certain about the future. They are more probably concerned about another round of correction in property prices. So how much Chinese authorities will decide to move forward into a bigger package, a bolder package or not, will determine the sequential dynamics of growth. But the more structural dynamics points in the same direction as you can see. And emerging markets will be a little bit of a consequence of the main blocks, US, Europe, Japan, and China. Some emerging markets are commodity exporters, so they prefer China to do well. Some of them are commodity importers, so they have a different incentive. In Latin America, it's with the exception of Mexico, it's a region that exports commodities to China, so they tend to do well when China does well, and it's a region that doesn't save much, so they need the excess savings from the rest of the world. They need capital inflows, which means that when interest rates are high in the US, that's not good for Latin America because you don't have a lot of capital inflows into it. Emerging markets in general do well when global growth is driven by China, and less well when global growth is driven by the US. And in particular, the recovery in the US has been mostly driven by the service sector and not by the goods sector. So this is not so good for the rest of the world. For instance, there's not a lot of people know, if I ask around whether you think that Europe export more stuff to the US or to China, the natural reaction would be, no, they are moving to China. But actually Europe exports more to the US than to China. But since China is slowing down, this is not good news for Europe, it's not good news for Germany. And since the US is recovering, but mostly on the service sector, this is not also good news for Europe because the US is not consuming necessarily more goods. So the nature of the recovery of the big blocks determine the fate of emerging markets. So emerging markets will do okay and probably recover in the second half of the year, and you're gonna see it in growth numbers, in average growth numbers in 2025. Now, when you take a look at inflation, with the exception of China, that is more flirting with negative inflation or very low inflation, the way you want to call it, the rest of the countries or the rest of the regions have experienced roughly the same inflation dynamics. And in most of the regions, the same thing is happening. You have a significant disinflation in the last 2 quarters or so in goods, but not so much disinflation in services. Services is much stickier than goods. In the case of the US, some people argue that this is a point about rents, on the size of rents in the CPI or the PCE that is too big, but actually when you take a look at CILO or the marginal information on rents and what people are paying on rents at the margin, it's much lower than what the CPI or the PCE shows. So eventually, the arithmetics will lead you to a rapid drop in service inflation. That is technically true, but I don't buy that story much. And on the other hand, the most important thing about that is that when you have some change in relative prices, people substitute away into other stuff. In this case, goods became cheaper. People might substitute away from services into goods. So not all the central banks reacted the same way to the increase in inflation. Emerging market central banks didn't have the credibility to tell people, oh, this is just a relative price shock. This is going to go away. Don't worry, I'm not going to do anything. They had to hike interest rate as soon as the shocks hit because inflation expectations otherwise would have gone wildly. ECB, the Fed, they have more credibility, so they waited a year longer than emerging markets to start hiking interest rates. So not surprisingly, many emerging markets, Brazil, Chile, a few Central Europe, Central European countries, and a few Asian countries are already cutting interest rates. Although developed markets, central banks are still in a wait-and-see mode. So in the US, this is what we expect sequentially. So we had an aberration, I would call it, in the third quarter, massive growth. There was a huge surprise in the increase in inventories. Then we had still about 3% growth fourth quarter of last year. We expect 2.5% for this year. The US team changed the growth forecast recently, actually last week. And then 2%, this is quarterly growth, annualized, seasonally adjusted annualized. And then we expect 2% growth until the end of the second half of next year, and then a bit of a slowdown to 1.5%. Potential growth in the US could be something between 2.25%. So the economy is running at roughly at potential. You could argue that it's above potential now and will eventually converge to potential throughout the year. Why the economy has been so resilient? Well, disposable income has been very strong. There has been, and disposable income being strong was a counterpart of the labor market being very strong. Excess savings has been very big because of the fiscal transfers. So in the US, the way the fiscal policy dealt with the pandemic, or the government dealt with the pandemic through fiscal policy, was to just transfer money to people, and people are starting to spend that. And then you have a significant increase in real wealth in households. There was a combination of run-up in financial assets and also the fact that housing prices held really well. It's north of 15-20%. And then another aspect that has been sort of has not been enough of focus is the fact that when interest rate collapsed during the pandemic, a lot of households and corporates rushed to refinance their debts, their mortgages and corporate debts. So basically, they hedge their exposure to higher interest rates. So when you hike interest rates, but people have a hedge, it will impact the budget or for the income of those households that much. And in the case of the US, different from other countries, and we publish a comparative study on that, 85% or so of the mortgages are fixed rates with long terms. So the private sector is pretty hedged against that. There are different estimates on when those hedges will start to expire, and then you're going to have some pressure on refinancing. But probably this is not a story of this year. It's more a story of next year, in particular for corporates. When you put everything together, it's not surprising that the economy did so well. Now, if the economy did so well, why inflation is falling, and why nominal wages are growing at 4% instead of growing at 10%? Well, what happened is the following. The increase in the demand for labor when the economy reopened has been met by an increase in the supply of labor that is explained by two things: an increase in labor force participation and also an increase in immigration. The point I want to stress is that so far, the increase in the demand for labor has been met by an increase in the supply of labor, and that's why the labor market is doing so well. We've had very strong payroll number today. There was a revision to the January numbers, but still the story when you do 3 months moving averages is that the economy is doing well. My concern is that if the demand for labor remains very strong in the coming months, and the supply of labor does not meet those increases in demand, we can have some pressure on wages. It's a risk. I'm not saying it's baseline, but it's a risk. The US team expects the Fed to start cutting interest rates in June of this year, in clips of 75 basis points per quarter. If you ask me about the risks to that call, I am more concerned about the risks for inflation to pick up from here or not to continue slowing down or moving lower as nicely as in the last 2 quarters, and the Fed to delay the easing cycle. The way I think about the economy is the following, and the way I think the Fed thinks about the economy is the following. Imagine that the economy is growing with supply and demand growing at the same time. But supply is temporarily growing faster than demand. So you're gonna see this inflation and the economy growing. But if for some reason supply stops growing faster than nominal income, then when supply normalizes, you want to see how fast is nominal income growing to see if there could be a pickup in inflation. The reason why most of the disinflation happening in goods is because of the normalization of the supply chains. That's the supply is growing faster than demand temporarily. But you're not going to have normalization of supply chains explaining disinflation for the next 3 years. This has a limit. Once everything normalizes, this is the supply side of the economy. Deal with it, unless there is more investment that there is. And then the question is how fast demand is growing. And I think the Fed wants to see more of that. That's why the Fed is saying, yeah, this inflation is good, is great, but I want to see this inflation in services. Because remember, the US economy is 70% services, 7% goods. If you talk to a CEO of a company in the goods sector and a CEO of a company in the service sector, and you talk to them, and you don't know what country they are talking about, you might think that they're talking about a different country. Because the dynamics could be very different. So what is different about Europe? Here you can see how consumption recovered in the US versus Euro area and the UK. And employment, how employment recovered. So you can see that in the US, employment collapsed during the pandemic and then recovered very fast. And in Europe and the UK, employment didn't fall much. So what happened? I mean, there was no pandemic in Europe. So what happened is that the US market, the US labor market functions completely different from the European market. In the US, you had a lot of fires, people got unemployed, and then rehires. Very flexible labor market. And people got checks directly. So you lost your job, but someone sent you a check. In Europe, it adjusted through hours work. People kept their jobs, kept making, if they were making 100 in salaries, they're still making 100, but they're working, say, half of the time. So if you have a company of 2 people, in the US, you fire 1, and in Europe, you kept the 2 working half time, but keep paying. So who's paying? Well, the subsidy, the part of the wage that was not work, was paid half by the profits of the company, with the profits of the companies, and the other half with the government, roughly. And again, on top of that, the size of the fiscal bucket was bigger in the US than in Europe. So that's why employment didn't fall. So why is this important? Because when the economies recover from the pandemic, the goods sector and the service sector didn't recover at the same speed. At the beginning, when you were locked in your house, what do? You bought stuff from Amazon. You couldn't go to a restaurant. So when you reopen, you stop consuming that much goods and you start to consume more services. In the US, people lost a job in the goods sector and got a new job in the service sector. In Europe, they never lost a job. So the reallocation of labor against excess supplies of labor sectors to excess demand of labor sector, it was more difficult. That affected consumer confidence and obviously consumption and the recovery. So that's one aspect. The other aspect, as I said, is the size of the energy shock was much bigger in the US than, in Europe than in the US. And with that story, the ECB, we also expect to start cutting rates in June for completely different reasons. Remember that there's a dual mandate in the US about employment and price stability. The ECB has a single mandate on price stability. So you might argue that they might care less about economic activity and they should focus more on price stability. So even though the economy is doing much worse in terms of economic activity in Europe than in the US, they are still waiting to see more progress, in particular in service inflation, to pull the trigger. So long story short, we also expect the ECB to wait until June. So I said that the balance sheet of the private sector, non-financial private sector in the US is pretty healthy. Banks are okay. I'm not really worried about one regional bank here and there. But the worst balance sheet of the economy is the public sector balance sheet. So in the case of the US, last year, the primary deficit was 5 points of GDP. And 2.5 points on top of that is the interest bill, 7.5 points of GDP for an economy that is running at potential or above potential. That's too big. The only reason why the US can get away with that is because it's the reserve currency of the world. Okay? That story in Brazil, and we are discussing Lula needs to be taken out of power or whatever. So we need fiscal consolidation in the US because otherwise that will imply either higher real rates or more financial repression or eventually higher inflation. I'm not saying it's going to happen tomorrow, but we are going towards that direction. So how do you do fiscal consolidation in the country? You either increase taxes or reduce spending. I don't hear any plan to increase taxes in the US. And about reducing spending, 70% of the spending is mandatory in the US. So it's very difficult to do a reform to reduce spending. So this is something that markets are not paying enough attention, and eventually will be something that they would get at maybe when we get closer to the election and the candidates talk about their platforms and the fiscal programs. But this is something that it's a concern. It should be a concern, and definitely will affect the decision-making process of the Fed. And it's also affecting a concept called R-star, which some of you might have heard, which is basically the natural rate of interest of the economy. It's the real interest rate that is consistent with full employment and inflation at time. And there is an argument, there are many arguments, and I agree with that our start is probably much higher now than pre-pandemic. And a lot of studies, and it's difficult to measure that, but most likely the reason why we're having an increase in our start is because, in part because of fiscal policy, in part also because there is an expected productivity boom in the artificial intelligence sector. Just take a look at the Magnificent Seven valuations, and you can see that someone is expecting something very good happening to the West in the next few years. And you can see it also in the increasing investment in the, especially in the first half of last year, due to the CHIPS Act and Inflation Reduction Act. That was another reason why the economy did so well. So consumption resilience and increasing investment due to the CHIPS and Inflation Reduction Act and the fiscal impulse. Those were the three reasons why the US surprised to the upside in terms of growth last year, or has surprised to the upside in terms of growth up to now, I would say. Yeah, no, it was transitory. At some point, you're going to go back to the steady state where you consume goods and services. But when you were locked in your house and you couldn't go on vacation, you said, okay, I'm going to do some renovation of my house. Probably you were going to do the renovation 3 years later, but you do it now because I'm not going to go on vacation anyway. So eventually you're gonna bias back to goods your consumption basket. But now you're catching up on service. Everybody wants to go on vacation like the next pandemic is in 6 months.
It's not the shift to artificial intelligence or stuff like that. It's just transitory.
No, look, this is a very important question. We don't see the AI increasing productivity in the data yet. Mm-hmm. It's more in the price of the stocks. So it's more like the people expecting the productivity boom but we don't see it in the data. The increases in productivity that you see are cyclical, but not necessarily structural yet. So the cost versus service recovery story, I would say, is more a shift in preferences, a temporary shift in preferences, rather than a technological issue. The fiscal imports this year is going to be much smaller than next year. So for growth, what matters is not the size of the fiscal deficit, is the change in the fiscal deficit. So the fiscal deficit not only was high last year, it changed, it's almost doubled from the previous year. So that's why it had an impact on growth and I would eventually on inflation. This year is going to be different. The primary deficit will be somewhat smaller than last year.
Do you think IRA is helpful to reduce inflation?
Yeah, on the Inflation Reduction Act, eventually that will increase potential outputs. But in the short term, it's more spending. It's investment. So in the short term, we'll eat up a little bit the economy. I am not sure both that we had in the first half of last year and the slowdown that we had the second half on the investment related to the chips and the Inflation Reduction Act will pick up in the second half of this year. It's a question that we are asking ourselves. We are not sure. But if that happens, that could put some pressure on the economy.
But some people think reshoring accelerate the cost.
No, exactly.
Yeah.
Eventually, you're going to have more potential output, but you have to build the infrastructure, so that's more pressure on the existing capacity of the economy.